Hey, in this video, I'm going to talk all about the ICT Power of 3 concept, and we're going to explain in detail the smaller fundamentals within it that create higher probability scenarios. So for our first slide, we're just going to showcase what an open, high, low, and close looks like. This is every single candle that prints has an open, it has a low, it has a high, and it has a close, or the opposite. So open, low, high, close. And this is always going to replicate a certain pattern within the lower time frames. So if we imagine this candle was the hourly, inside the hourly, maybe the 3, 4, or 5 minute, you might see a pattern similar to this, where we'll create a little bit of a consolidation at the opening price, manipulate higher to create the high of the candle because every candle needs to have a wick, and then we'll drop lower to distribute, creating the low of the wick, and then finally bounce back off to create the closure. Same thing for the bullish candle here. We've got the low that's created after a consolidation for a distribution higher, and then it will create the top of the wick for the candle. Now, let's talk about the fundamentals. So just the three key fundamentals is obviously an area of consolidation. This can look a little bit messy sometimes. It's not going to always be perfectly clean up, down, where it doesn't take highs, doesn't take lows. However, that is a good characteristic. You want to make sure if you are looking for these that you do have some kind of stacked liquidity. See how we have buy side here and another buy side here. They're staggered. They're not, this hasn't taken this high, creating already potentially the manipulation lower. You want to see equal highs or relative equal highs or relative equal lows. That creates a triangle, a bit like the retail pattern where it will continue to leave highs and lows for the breakout. However, we don't want to trade the initial breakout because we're anticipating that that's the manipulation. So this is where we get the second step, which is a fast run on the high or low. You can see as we tap back into 50%, which typically is a characteristic of consolidating markets, is you will see many rejections and many continuations of staggering highs and lows created from the 50% line. So you know here we bounce back from, so we trade above 50, bounce up, trade back to 50, and we get a faster run on these stops. We know it's a fast run because it's created fair value gaps as it's displaced. Instantaneous at the top, we get a complete switch, right? Like we get our sharp reversal, which is a closure back below these candles, creating a CISD. Maybe you could say you've got your BPR now because you've got fair value gaps that are being closed over by inverses. So you've got some solid confluence of a sharp reversal. If this had just staggered lower and dropped slowly, it wouldn't be as high probability. It's not as clean. Them ones are probably just a miss. Now, time frame alignment. This is where you're going to look for, if your daily candle, if you're anticipating your daily candle, okay, let's go back a few slides. If you're anticipating your daily candle to look like one of these, you want to choose a lower time frame to reflect this price action. So if that's your daily, you want this to maybe be the hourly, right? Same for the 4 hour would be the 15, the hourly would be the 5, 15 minute would be the 1. So exactly the example we used earlier. If you're expecting a 1 hour power of 3, look within the 5 minute chart for confirmation. I would even say go as far as using the 3, 4, or 5 because they're very similar, and you might have some time frame distortion where one time frame doesn't correctly show the story that's being told, whereas the other one does. Now, what creates a higher probability scenario is when we have a higher time frame liquidity sweep. So if we go back to an example like this, let's say there was even more buy side up here, something where we tagged into some real higher time frame PD array, or maybe there's a big open 4 hour gap just above this high. This is going to create a higher probability sharp reversal. Now, other scenarios that create higher probability scenarios are daily opening prices, session opening prices, and silver bullet opening prices. If we expect the daily candle is going to be bullish, we want to be a buyer below the daily open. If we expect the session is going to be bullish, we want to buy below the session open. Same for the silver bullet, which is an ICT kill zone model in itself. The speed of reversal, that's a very key point. The speed of a reversal will often indicate how likely you're involved with smart money. Like the larger the larger entities, the larger institutions, the banks, whoever's behind this move. If we get some kind of sharp reversal, it indicates that they've loaded up positions and the market's aggressively spooling to take some area of opposing liquidity, whether it's the internals here, 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 or maybe some external low. No, we want to avoid lower volatility days. These are bank holidays or pre-news days. So on the day of recording, there's currently a Euro bank holiday, which does create lower probability scenarios. This means that you're less likely to get that speed of reversal. So these points are somewhat linked in a way. Pre-news, news always creates volatility. News creates, anticipation of what might happen. You might already have the sweep higher and news opens like here in this candle. It might sweep it again to then drop. So you want to always wait for news. News will create that move that you're looking for. News often manipulates into stops to then run higher or lower. You want to match the PO3 concept with daily, weekly, or session profiles. We know that ICT has many different profiles of weekly patterns and daily patterns, such as the classic ICT buy day, or maybe you have the, Thursday reversal, the Friday consolidation pattern, and matching the power of three concept with this. So if we know that we are getting a classic buy day, we know that maybe the London session's been bullish. New York should give a retracement for a continuation higher. That means we want to frame our long below the New York session open because that will give us the highest probability of an expansion higher for our trade. Okay, and then the last bullet point is overlapping multiple time frames, power of threes. So, you know, preferably the 4 hour and hourly if you're going to use intraday, because this occurs a few times, but mainly within the sessions we want to trade with higher volatility, right? Because we want to avoid lower volatility. This occurs at 3 a.m. open, 10 a.m. open, and 2 p.m. open. That's our silver bullet opening prices. So you can see how they're very, very linked into this opening price is very, very high probability, and it's something to be aware of. That 10 a.m. open is probably the best out of all of the three, just because of volatility purposes. And you'll also note that major news events are opening at these times. We typically will get some sort of large GBP news probably at 3, or a large USD news at 10. FOMC, I believe, is at 2 or 2:30. If you're considering the second stage move of it. So, some important times and moves are happening at these times because of how the power of three is setting up. Here we are with targets and stops. So when we're considering our trades and where we want to exit and enter, if we're entering in the open area of the wick, so let's imagine that price has opened somewhere here, it's consolidated, it's made the high of the wick. So this is the wick high, this red line. If we're positioning inside here as we're dropping lower, our stop loss doesn't need to be up here. It can be on this wick high because we're anticipating that this high is safe. This high will hold as we drop lower. And any internal low, so the internal lows we staggered in the consolidation area, maybe internal lows like this, even less about lows, but more about fair value gaps, because fair value gaps are kind of lower time frame lows, or they have lower time frame lows inside them, right? So there's a little bit of techiness, but either way, like internal lows are good targets, and then obviously you need to have your external range liquidity, which is your higher time frame draw. So if you were entering, if you were anticipating that this is an hourly candle and you're trading on the 1 minute, you know that previous hourly candle might, the low of that might get taken. There's a high probability. So that could be your external range, and you could frame a nice risk to reward off of that, somewhere from 1 to 2 to 1 to 5. Now, I hope that answered any questions. I think that there's not too much more to use in terms of Power 3. It's a very simple concept, but it has a deep impact on, position sizes and, make, because if you can get a smaller a smaller, tighter stop, it can impact your risk to reward in many ways. And that's based on the confidence knowing that that low or that high is safe, which comes from Power of 3. And there's a few other things that stem off that, but either way, like, it, it's a great tool to have. It's a understanding Power of 3 in your sessions is definitely going to help with improving your win rate. And so yeah, if you want any advice, any more help, we're building a nice free community of like-minded traders, people to bounce ideas off of. If you've got any questions, like I said, you can ask me. I'm in there, I'm active, and I hope this helped. So thank you.